In recent months, the U.S. Federal Reserve has adopted a cautious new stance toward monetary policy. During its December meeting, Fed officials made it clear that they would start slowing the pace of interest rate cuts due to persistent inflation risks. For anyone following economic news, this shouldn't come as a shock. After all, we've been bombarded with hotter-than-expected inflation data amid continued consumer spending and a resilient labor market. But what are the deeper economic issues behind this slowdown, and what might the long-term consequences look like for the U.S. economy and beyond? To understand this, we need to take a closer look at the various factors driving the Fed's pivot, and more importantly, how these factors reflect broader systemic problems within both monetary policy and the overall macroeconomic landscape. In December, the Fed underscored its intention to take a more measured approach toward further rate cuts. The minutes from the Federal Open Market Committee's (FOMC) December 17 to 18 meeting revealed a growing concern around inflation, with many participants highlighting the need for a careful approach in the months ahead. While the Fed cut its benchmark short-term interest rates by 25 basis points to a new range of 4.25% to 4.5%, the discussions during this meeting showed mounting anxieties over the persistence of inflation and the resilience of the labor market. For many of us, this immediately raises the question: after the Fed had been in full-on rate-cutting mode in 2023 to stimulate growth, what changed? Why is the Federal Reserve now reluctant to continue its aggressive approach? First and foremost, inflation is the big elephant in the room. U.S. inflation has been running hotter than anticipated for months, forcing the Fed to rethink its policy path. According to the minutes, almost all participants judged that upside risks to the inflation outlook had increased. The numbers don't lie. The Fed's preferred inflation gauge, the Personal Consumption Expenditures (PCE) price index, increased by 2.4% on a year-over-year basis, and 2.8% when excluding food and energy. Anyone watching the financial markets knows that the Fed has always treated inflation seriously. Even a seemingly small percentage increase in inflation is enough to spark concerns over potential runaway inflation, which could undermine economic stability for years to come. Considering that inflationary pressures have persisted longer than anticipated, the Fed's slowdown in rate cuts signals that officials are trying to avoid overstimulating an economy that is already grappling with price stability challenges. In essence, the Fed is walking a tightrope between wanting to foster economic growth and ensuring inflation does not become entrenched. Another major point of concern raised in the Fed minutes is the ongoing strength of the labor market. Despite the economic headwinds and global uncertainties, the U.S. job market has been surprisingly resilient. As many economists were quick to note, labor markets that continue to show signs of strength make it difficult for inflation to subside. Wage growth, while good for workers in the short term, tends to fuel further inflationary pressures because businesses pass on rising wage costs to consumers in the form of higher prices. The charts on unemployment rates and labor force participation have consistently shown that the labor market remains tight, with unemployment hovering near multi-decade lows. While this tightness in the job market has helped bolster consumer spending and prop up economic activity, it has simultaneously become another strain on the fight against inflation. In a nutshell, Fed officials fear that the booming job market could prolong inflation, which is part of the reason why they're hesitant to move forward with the kind of aggressive rate cutting that we've seen in recent years. Economic forecasts for 2025 and beyond are clouded with uncertainties tied to new policies expected under incoming President Donald Trump. During the Fed's December gathering, Trump's impact loomed particularly large. The Fed incorporated placeholder assumptions following Trump's election win to account for potential policy shifts on trade, tariffs, immigration, and tax reform. Historically, Trump has demonstrated a willingness to impose trade restrictions and tariffs, which could lead to broad disruptions across global supply chains. For example, during Trump's earlier administration, 2016 to 2020, the U.S.-China trade war was one of the most destabilizing factors in global trade, and it reverberated across the global economy. With more tariffs comes inflationary pressure as businesses factor higher import costs into prices for consumers. Additionally, lower immigration, another area of policy emphasis under Trump, could skew key labor markets, pushing up wages while further exacerbating inflation pressures. All things considered, the Fed's team is preparing for a rough ride with policy shifts potentially sending shockwaves through the economy, and they are understandably cautious about moving too fast or committing to a full-fledged rate cut cycle until they have more clarity on these factors. By stepping back and taking a holistic view of these developments, it becomes clear that the Fed is not just dealing with short-term fluctuations in growth and inflation, but rather addressing deeply embedded structural weaknesses in the economy. Let's break down the hidden vulnerabilities that persist beneath the surface of these rate decisions. One of the fundamental issues highlighted by the current situation is the over-reliance on monetary policy as a tool for managing the economy. For years, the Fed has had to shoulder the heavy responsibility of propping up growth primarily through interest rate cuts and asset purchases. However, as we've seen post-2008 and during the COVID-19 crisis, monetary stimulus has limited capacity to address deep-seated challenges like sluggish productivity growth, demographic shifts, inequality, or even the supply-side factors behind inflation. In fact, as monetary policy stays loose for extended periods, the risk of financial bubbles in certain asset classes becomes ever more pronounced. We've repeatedly seen asset price inflation in equities, real estate, and commodities following episodes of extended easy money. This situation has been exacerbated in recent years, and there are signs that we're seeing bubbles emerge yet again in parts of the housing market and the tech sector. Adding another dimension to this issue is the fact that interest rates had remained near historic lows for an extended period before 2023. While this low-rate environment was intended to stimulate growth, it also opened the door to growing levels of government, corporate, and household debt, laying the groundwork for systemic financial vulnerability if market conditions deteriorate. The inflationary episode now gripping the global economy is not just a story about excessive demand, but also a reflection of ongoing supply-side dysfunctions. From disrupted supply chains to energy market volatility, significant hiccups in global trade flows have contributed to rising costs. Take the semiconductor shortage, for example. This which has plagued industries like automotive manufacturing and consumer electronics for the past couple of years. This shortage, like many other supply disruptions, has contributed to higher production costs, leading to price hikes across multiple sectors. Similarly, persistent energy market volatility due to geopolitical tensions is exacerbating inflation in vital sectors. The war in Ukraine, for instance, sent global energy prices skyrocketing during much of 2022 and 2023. The subsequent inflationary pressure isn't likely to dissipate quickly, and any flare-ups in oil or natural gas supplies introduce further risks. At the same time, rising geopolitical fragmentation including trade conflicts, regional tensions like the West versus China dynamic, and protectionist economic policies is undermining the certainty markets and businesses need to plan ahead. The trend of deglobalization and friendshoring of supply chains where countries try to reduce their reliance on potential adversaries throws a significant spanner into the overall functioning of the global economy, driving costs up in the process and contributing to longer-lasting inflationary pressures. Trump's looming policy shifts could have a profound and lasting impact by accelerating this deglobalization trend. In that sense, inflationary pressures may become something of a geopolitical problem, as global supply chains are reworked and companies attempt to realign their operations based on a new geopolitical economic reality. Once stable supply chains are now at the mercy of policy shifts, trade negotiations, and diplomatic relationships. Moving forward, the Fed will have to be more careful than ever in its next steps. The risk. Cutting rates too quickly could fuel inflation even more, which would force the Federal Reserve to backtrack and implement rapid, painful interest rate hikes that could derail economic growth entirely. On the flip side, tightening too much or keeping rates too high might lead to an unnecessary slowdown in growth and risk pushing the U.S. economy into a recession. This conundrum, combined with structural issues like soaring federal debt, increasing social inequality, mounting global trade frictions, and plateauing productivity, creates a swirling storm of uncertainty. The Fed's cautious stance in 2025 is more than just a response to recent economic data. It reflects a broader acknowledgement that the U.S. economy must navigate these challenges carefully to avoid long-term damage. Moreover, with U.S. elections soon to re-enter the realm of political discourse, as always, we could see a further wave of policy unpredictability. Depending on the 2026 midterm elections or presidential elections in 2028, there may be new political pressures pushing for either continued rate cuts or a pivot to fiscal stimulus. At the end of the day, the Fed is cornered between a rock and a hard place. It faces the monumental task of managing inflation without triggering a recession or undermining an already fragile job market. Meanwhile, the broader economy is being increasingly squeezed by global geopolitical challenges, rising inflation, and deglobalization tensions, all of which could exacerbate structural problems that neither fiscal nor monetary policy alone can fully resolve. Ultimately, what we're seeing in the Fed's cautious approach is a reckoning. The U.S. economy, like many others globally, is facing the cumulative effects of years of overambitious policy goals, both on monetary and fiscal fronts. With fewer easy decisions left for policymakers, the path forward is fraught with risks. The Fed's commentary in its December 2024 meeting minutes reflects the gravity of the situation. Progress won't be swift, and cushions won't be as soft as before.